Welcome to you all once again. We are now entering into part 3 of this session of this second day. This is going to be a very interesting session for a number of reasons. You have seen the title of the session. It's the MNE Group Approach under Pillar 1, Amount A and B, and its interaction with the separate entity approach, including views expressed in the public consultation. So the purpose of today's presentation is not really to redo the consultation, of course, but also to take advantage at the same time of the recent OECD consultation to focus on some issues that deserve particular attention in the framing of the Pillar 1 discussion. And in order to do this, we thought that we would take a practical approach. We have 2 case studies that have been respectively prepared by my colleague Vikram Chan and Guglielmo Maisto. The purpose of these 2 case studies is to stimulate the discussion on some controversial issues arising out of the shaping of the Pillar 1. And we hope that with that, we'll be able to fuel the discussion and to contribute to open questions in relation to the Pillar 1. So before I turn the floor to Vikram Chan to present the first case studies, I'll be giving also the floor to each panelist during the presentation of the case studies for various inputs. Let me perhaps introduce the panel. So we will first begin by a general introduction, which will be given by Norman Wingen, who is a transfer pricing advisor at the OECD. This will be done before getting into the first case study, just to have, let's say, an overview and setting the scene. Members of the panel, as I said, include Guglielmo Maisto, Vikram Chan, Mr. Koen de Graaf, who is a managing director, tax and accounting services at PwC in Belgium, Fabio De Angelis, who is a senior director, global taxes at eBay, Elizabeth Stephen, who is a member at the law firm Kaplan and Drysdale in the US, and finally, Graham Woods, who is a vice president of global taxes at Procter & Gamble in the US as well. So you see, I think we have a very good balance of international organization with the OECD, representative of the industry and private practice. So with that, I will give the floor for setting the scene segment to Norman. So Norman, please, the floor is yours.
Good morning. Thank you very much, Professor Danan, for this kind introduction. And of course, thank you very much for the invitation to speak. I think it's a great panel, or should be a great panel, really, to discuss on practical cases what are the consequences of the blueprint. And yeah, as you said, I will give in the first 15 minutes a little bit of background with regard to the blueprint and setting the scene for the case studies. And this slide, which you see on the screen, should be very familiar to many of you. It's kind of an overview of Pillar 1 with the 11 different building blocks. That's the only slide I will talk about, but don't worry, I will not go into each building block in detail, because the focus of this panel and the next session and the discussion about the case studies, it's really the interaction between the separate entity approach and the MNE Group Approach, which is proposed in the blueprint. And I will just then highlight which building blocks are most prominently touched by these challenges. So when we talk about the interaction, why are we talking about that? Or what do we actually mean? And the interaction is coming from the design of the new profit allocation, which keeps the existing profit allocation under the transfer pricing system and the profit allocation to PEs. And on the first level, or on the first layer, I would say. And then we have heard yesterday also on a second layer, the new profit allocation will be put on top of that. and that's AmountA. And therefore we have like now two different layers of profit allocation. And by the way, AmountB, which is the baseline, which is a fixed return for baseline marketing and distribution activities, is still in the first layer in the existing transfer pricing allocation, because the design is so that AmountB should approximate an arm's length return for these activities. But yeah, again, so we have the first layer, the profit allocation, the existing profit allocation, and based on that, AmountA reallocates parts of the profits to the market jurisdictions. And therefore we have a certain interactions, which are challenging, but which we are optimistic that we can address these. Going into a little bit more detail of these interactions, and looking at the different building blocks, I think we should start with the text-based determination, because the text-based determination really highlights the new system, that the new system, and the particular AmountA, that it's really a group approach. Because the text base, which should be reallocated to the market jurisdiction, should be starting or should be the consolidated profit before tax. It's really like a group profit number. Thinking about that, different groups have different accounting standards. It is proposed, or it was discussed, and it is proposed that all accounting standards which are equitable to IFRS, that they are acceptable. There should no book-to-book adjustments. There should no harmonization adjustments between different accounting standards. There should only be a limited number of book-to-tax adjustments. And in the current world, in the current profit allocation world, there's a lot of effort and work done to really come with to determine the taxable income of a separate entity. But for AmountA, they should really be limited, because the adjustments, these book-to-tax adjustments, are really specific to each jurisdiction. And to keep it simple, it should be really limited, and just be, for example, dividends to avoid double taxation should be eliminated. But that's it's really a limited adjustments. And yeah, then you have the tax base, which is the consolidated profit before tax, which is the basis for the AmountA calculation. It could become a little bit more difficult or challenging, because in certain instances there might be a necessity to segment. It is acknowledged in the blueprint that segmentation would increase the complexity significantly, and therefore it's also only proposed to segment when it's really necessary. That means if a MNE group has out of scope and in scope activities, then of course you have to segment to really come to the in scope activities. And the second reason to segment might also be to avoid distortions if there are different business activities which have significantly or material different profitabilities. And then my last comment on the text-based determination is losses. Losses, you also see that it's a completely new approach, because we are not talking about losses on a legal entity basis, and then the question, how can they be used? If there are losses on a group basis, then they will be kept and calculated on a group basis. And that's just in line to the group-wide calculation of AmountA. But there is no direct link of these losses to a separate entity. And I haven't, on the text-based determination, I have not talked a lot about the interaction, but the text-based determination just highlights really the new approach, that it's really a group approach, which is different from the current corporate income tax approach and profit allocation approach, where you determine the taxable income per legal entity. The next building blocks, which has has interactions between the current profit allocation system and the new system, is of course the profit allocation. Because again, the profit of the MNE group is already allocated throughout the world on a first layer in the current system. And then there's just the overlay of AmountA. And the issue which is significant for the interaction is the issue of double counting. Double counting just says that it should be avoided that the same profit should be taxed twice. Because in the profit allocation, you have to take somewhere the residual profit, which should be reallocated under AmountA and allocated to market jurisdictions. But imagine you have a very centralized business system where it's easy to identify the residual profit in one central location. But this central location is situated in a country where it's also a market. So then if you take the residual profit of this entity or this country and reallocate it to the market, to the same country, then you have an issue of double counting, because you allocate residual which has already been allocated under the current systems to this country. That's the issue of double counting. There are different approaches to address it. The first one is, of course, the elimination of double taxation. In the example where we really have a central entity who hosts all the residual profit for AmountA, then if that's the paying entity, this paying entity should also relieve the double taxation. So then there's a netting effect. But if you imagine you have a decentralized business model and you have residual profit all over the world, then the question is really, well, or that poses significant challenges for double counting, because not all countries probably are paying entities and relieving double taxation. And in the same train of thought, I would say, is also the issue of withholding taxes. If you have withholding taxes in market countries, then you already have taxes paid from the foreign entity. So, and again, there might be an issue of double counting. There are two ideas explained in the blueprint how this issue of double counting could be addressed. The first one is called the marketing and distribution safe harbor, which basically says, well, if you already have in the market jurisdiction enough or sufficient residual profit, then there might not be an additional AmountA allocation. That's the first idea. The second idea is the so-called domestic business exception. And this addresses, admittedly, maybe not many cases, but it could be that within the MNE group, you have like a really domestic business where kind of on a standalone basis, where the residual profit is already in the market jurisdiction and would then, through the reallocation, just reallocate it to the same market jurisdiction. And then the idea is, well, to carve this out. Of course, this poses issues with like how to define such a domestic business, how to segment it. But these are two ideas which are explained in the blueprint. And as said yesterday, these are also two areas where further work needs to be done and further discussions have to be held. I have two more areas of interaction. The next one is the elimination of double taxation. And this is really very prominent because we are talking about a reallocation of profits, and the elimination of double taxation is really addresses where is this profit, this residual profit coming from, and where should it be, where should the double taxation be relieved. So therefore there's an interaction between where the profit is allocated under the current system and where it should be taken from in the new system. And there are different steps explained in the blueprint. The first one is you can look at the activities the entities are doing, the legal entities are doing. This is kind of like a transfer pricing approach. You look at where's IP, where are DEMPI functions, and you can then determine on that, in this way, the paying entity. The second step would be then the profitability threshold. So to ensure that this entity also has enough profits to relieve the double taxation or to pay the tax, it needs to be, well, on a just quantitative threshold to have enough profits. And the third step in this elimination of double taxation is the so-called market connection test. Some countries are saying, well, when I'm taking the residual profit under AmountA and reallocate it to market jurisdiction, then I should reallocate it to market jurisdictions which have a commercial or business link to this residual profit. And therefore, there is like a market connection test. In other words, it should be avoided that if you assume an MNE group with two different business lines, one is very profitable, one is not that profitable, that the very profitable business line is paying or is reallocating profits to markets where its own business line is actually not present or it's not active. That's the idea of the market connection test. So there were, I think, a lot of interaction between in the profit allocation and in the elimination of double taxation, which we will discuss further in the case studies. My last point before I close is really a very practical issue where you see the interactions between the current profit allocation system and the contemplated AmountA. I assume that there are a lot of transfer pricing practitioners listening in. And you are always dealing with transfer pricing adjustments coming out from tax audits. And the question is here, because they are always done in later years and on a retrospective area, how that should be considered in the AmountA calculation. And we already heard yesterday from Matt that that's really a challenge. And it's pretty difficult to change the AmountA calculation retroactively, in particular if you have like hundreds or a lot of countries who could have these retroactive transfer pricing adjustment. And it just highlights the importance of the tax certainty aspect of Pillar 1. And there in particular the tax certainty beyond AmountA, because such a transfer pricing adjustment could relate to issues, to regular transfer pricing issues. And if tax certainty is addressed for these tax transfer pricing adjustments, then they do not need to be taken into consideration retroactively for the AmountA calculation, which would be very hard to open up. And I hope that I acknowledge it was a really fast run through to some of the issues, but I hope I could set the scene for the coming discussion of the case studies. Thank you very much.
No one. This is indeed a very good introduction, and it sets the scene. I think now I will give the floor to Vikram to discuss the first case study. So he will basically present the factual background and then opening the discussion to the panelists for various inputs. So Vikram, the floor is yours.
Thank you, Mr. Dannon. So the first case study that we will be dealing with pertains to a consumer-facing multinational enterprise which is engaged in the sale of physical goods. And the case study is as follows. Before we jump into the case study, I would just like to highlight what is the MNE's business model under the current framework. So in this situation, we are dealing with a US parent which has developed its own trade and marketing related intangibles, and it operates as a full-fledged manufacturer for the US market, and it's a highly profitable entity. And then it decides to go outside the US and venture out into the world and start selling outside the US for its offshore operations, which is around the world. And we are just going to see the European leg here. It sets up a principal in Switzerland, and it licenses its IP to the principal. And the Swiss principal has exclusive right with respect to its offshore IP, and in return, the Swiss principal pays a royalty to the parent. Now, the Swiss principal, which is in charge of the European market and in some parts of the non-European market too, actually sells the products of this multinational in 3 different countries, in our case, outside Switzerland. So the products are being sold in the US, the products are being sold in Switzerland, and in addition, the Swiss principal sells products in India on a remote sales basis. So it's done through independent third-party distributors, and there's no tax that is being reported in India. When I say no tax, it means no corporate income tax, because there is no permanent establishment or separate legal entity in India of the multinational. So it's just making remote sales and it's receiving money from India. So no tax in India under the current framework. At the same time, it's selling into Germany through a limited risk distributor, which belongs to the group. And the limited risk distributor is reporting a return on sales, which is at arm's length. And this is a 3% return on sales. So if the sales that are being made into the German market is 100, the profitability, the income that is being reported by the German company is 3% on sales. And then we have the Swiss principle, which is operating with a decentralized kind of structure with respect to its operations in France. So the group has a French subsidiary, and to this French subsidiary, the principal sub-licenses the IP. And then there's a payment of royalty, which is linked to the sales which are being made locally by the French entity to the Swiss principal. And the Swiss principal, in this case, they're receiving the royalties. So the French entity that is making the payment could actually be a full-fledged manufacturer or a full-fledged distributor. Now, these terms are very commonly understood for transfer pricing professionals. Full-fledged manufacturer or full-fledged distributor essentially are entities which are quite independent, and they make decisions in an independent manner compared to the rest of the group. So the level of dependence on the principal or the parent is very low. It's important, but very low. So a French entity is paying out royalties, and on the royalties that are being paid out, there's actually let's just assume there is a withholding tax in France in our example. At the same time, the French entity is reporting arm's length remuneration of 5% on sales post royalty. Now on the Swiss side, the Swiss principal in its under the current framework, it's reporting 15% an arm's length return of 15% on local sales post royalty that has been paid out to the US. And the US entity, based on its, because the US entity is selling only in the local market, it's reporting an arm's length return on sales of 20% on sales, on the US sales, which are being made. So this is the current framework. And if you see in this entire case study, the multinational is selling products in US, Switzerland, India, Germany, and France. Now, with respect to the consolidated financial statements, which have been prepared according to the US rules, we will assume here, the group has a consolidated revenue of 1 billion, which is 1,000 million. And at the same time, it has some dividend income and gains on sale of shares of external investments it has made in companies in which the US core has around a 10 to 20% interest, ownership interest. At the same time, there are some expenses at the level of the consolidated group, and the consolidated expenses amount to a lot, and they are broken as follows. So you have cost of products sold, R&D costs, selling and marketing expenses, administrative costs, interest expenses, losses on revaluation of shares, and an income tax expense that has been booked. So the profit after all these above expenses have been taken into consideration is around 250 million. So you have your revenue, which is global revenue, which is being reported of 1.1 billion. And you have your expenses, which amount to around 850 million. And this is based on the consolidated financial statements. Furthermore facts, which are very important for our case study, is that 10% of the global sales of this multinational are derived from India. So 100 million of revenue is flowing in from India, 200 million from Germany, 300 million from France, 100 million from Switzerland, and finally 300 million from the US. So this is how the sales, so the consolidated revenue, when we have the consolidated sales figure, these are the sales which are being made to third parties. These are not intercompany sales. These are third-party sales which are being reported by the group. So those are the facts. And this is where we get into the discussion. And the first question, and which Norman has also highlighted, is one of the most important questions, is how do you go about determining the amount A tax base? How do you do the tax base determination? Assuming the nexus thresholds are met, because the nexus here, we're talking about, more than 100 million of sales in each jurisdiction. So I'm assuming that the nexus threshold is met. So the question is, how do you go about determining the tax base? So a possible solution in our case study is that we take the consolidated group operating revenue, which is around 1 billion. We take the consolidated group operating expenses, which is around 800 million. And we arrive at a standardized PBT amount of 200 million, which would actually give us a standardized group PBT margin of 20%. So how did we come that to a 20% PBT margin is 200 million by 1 billion. And if you see here, to calculate the standardized PBT, we've made some minor adjustments here with respect to the dividend income, the gain on sale of shares, as well as some kind of expenses which have been linked to acquisition of stock or some extraordinary items. So we made these little adjustments, and this is what is being contemplated in the AmountA calculation too, is that the amount of adjustments that are going to be made to the consolidated financial statements have to be kept at a minimum in order to determine the tax base. So here we've come out with a tax base of around 20%, which the multinational is which would be the tax base for this multinational enterprise. The standardized PBT 200 million and PBT margin is 20%. Now, before we go ahead with this case, at this stage itself, I would just like to take the liberty, and if Professor Dannon allows me, to ask Cohen one question. The way each multinational group actually presents its financial statements is different. Now, is it feasible to find common ground to determine the tax base using financial statements? Now, what are the main challenges you foresee using IFRS or GAAP-related statements, especially for segmentation? So, Cohen, the floor is yours.
Yes, well, thanks, Professor Chand. Well, at first sight, making use of consolidated financial statements to determine AmountA, or at least as a starting point, it looks fine in the sense that, well, that is information that is available. In multinational entities have group financial statements when we talk about groups with revenue of more than 750 million euro. So they have it available. There is no global tax return available. So I would say it seems to be a good starting point. But of course, financial accounting is not tax, and that has primarily to do with the purpose. So what is the purpose of financial statements? We have to go a little bit back in history. So 1973, it's the creation of International Accounting Standards Committee. And the main idea was, in fact, to have relevant financial information, relevant, reliable, comparable also, information for the main stakeholders. And what are deemed to be the main stakeholders for financial statements? It are primarily I would say, the potential investors, the creditors, the lenders. So in other words, persons or organizations that have to choose whether or not to allocate resources to the group. And so this should be relevant information primarily for these stakeholders. Of course, there are other stakeholders as well, but that was the initial idea. If we then go to the purpose of taxation, I would say there are different purposes, but one of them is tax policy. So how do you, by a legislative process, how do you drive behavior with citizens, with companies, and all those who are being, I would say, involved. So a simple example, take research and development tax incentives. You see them in a variety of forms and formats throughout the world. Of course, they are intended to, I would say, to encourage investments in research and development. So that kind of policy or purpose is not the purpose of financial statements. And so because there is another purpose, you obviously also have a lot of different rules. So And therefore, the profit before tax that was just being mentioned by Norman, that profit before tax on a consolidated basis will, of course, differ from the taxable income of a company and of a group. And so it is, well, a choice being made in the context of the blueprint to limit the number of adjustments to be made and to come up with what you call to be the standardized PBT. Yeah? So practitioners in tax accounting, so that are involved in accounting for income taxes for a multinational group, they fully realize how many differences there are between financial reporting rules and tax rules in all of those jurisdictions. The blueprint wants to keep it, I would say, relatively simple, although you can't call it simple, Pillar 1, but they want to reduce complexity and make it, I would say, manageable from an administrative perspective to limit the number of adjustments. So that about the financial statements as a whole. If we then go to the segmentation, so yeah, why could segmentation be relevant to determine amount A? So there are in fact two main reasons. The first one was already mentioned by Norman, because an international group does not necessarily only do activities which fits within the, let's say, within the framework of Pillar 1. Pillar 1 addresses two main activities, but of course, an international group can do other activities as well. So that's one reason. Another reason is that even within those activities, you could have different profit margins. So proportionally significant differences in profit margins, which also drives or make, I would say, segmentation relevant for the purpose of calculating amount A. Now, in the standard, better sit in the blueprint, there is a reference, and in fact, there is also a rebuttable presumption that, in fact, IFRS 8 should be used as a starting base. And if you go to other accounting frameworks, so for example, US GAAP, which is an equivalent to IFRS, there you have a very similar standard for particularly segmentation. Here again, there is a different purpose. So the main driver for segmentation under IFRS 8 is in fact what internally within a group is being reported to the chief operating decision maker. And the chief operating decision maker, it can be, depending on the group, it can be the CEO, it can be an executive committee. So it can take different forms and shapes, I would say, but that is determining what is in practice being reported in terms of different businesses. So starting from that perspective, under IFRS 8, it also not really determines the format of disclosure for segmentation. That means that all of the different line items, for example, that are being disclosed, are not necessarily the same line items as the income statement. So for the primary statements under IFRS, like for example, an income statement and a balance sheet, you have a bunch of rules, IS1. For segmentation, those rules are not fully applicable. And so there is a lot of variety in terms of disclosure. And that has as a consequence that in terms of profit measures, we talk just about profit before tax on a consolidated basis. But when we look into the disclosures of different groups, either under US GAAP or under IFRS or even other accounting frameworks that would be equivalent to IFRS, there we see that some groups use EBIT, others use EBITDA, and others use net profit income or net profit sales revenue or whatever. So there are a bunch of let's say profit measures being used, which are not really defined by IFRS itself, but defined by the company typically. So it will be, I would say, that would be one of the challenges. How do you in fact, make comparisons between the different groups with different profit measures. Another, I would say, a point is that IFRS 8 is not mandatory for private groups. So assume if it's not mandatory that they don't do it because they are a private group, yeah, what alternative are these private groups using for segmentation if they don't already do it under their financial reporting standards? And then, of course, also, well, the segmentation is not always in line with the transfer pricing policy of the group. Sometimes there are headquarters costs that are allocated for transfer pricing purposes, but not necessarily allocated for the segmentation between the different segments. So also that is something I would say that makes it worthwhile to further address in the blueprint.
Thank you very much, Cohen. Before going to Graham, just one follow-up point on the first part of your intervention. You were essentially mentioning fundamental divergences as regards the purpose of accounting standards and tax and the blueprint. But you agree that these divergences are somehow not new, in the sense that they are addressed in most tax systems. You were referring to, for example, research and development incentives. It's not even the purpose of tax law to introduce these incentives. It's always outside the purpose. So I think you agree that this tension is not really new.
It has always been existing. What is new is, of course, that now we start from consolidated financial statements to determine an amount A. So that is new, but the differences have always been there and will always be there in the future. It's just a matter of managing them in the context of amount A by determining, okay, what will be the adjustments to be done? And that's both a technical question, but primarily also a political question.
Yeah. Yeah.
Robert, may I make just a very short comment?
Yeah, go ahead.
This debate makes me think about a discussion which took place several years ago on the CCTB in Europe, when basically we tried to have a consolidated or a common tax base, because that is basically what we are talking about here. And we all know it failed, although it's now being proposed again shortly by the European Commission. So it is possible that if OECD is good enough to make everybody happy, then it might pave the way for a European CCTB. Second point, which is more, if we have time, a question to Norman, he mentioned carving out investment income. He mentioned dividends. But sometimes you may have a difficulty to establish whether you are the investment income or not. If you take a silent partnership, for instance, where you put capital in return with a business risk. I don't know whether you have addressed that point in your work. That's all I wanted to say for the moment.
So I don't know, perhaps Norman, if you want to quickly react to this, and then we can move to Graham.
Well, that's a good point, and that still has to be analyzed. I mean, there are still a lot of open questions, also like joint ventures, the income from joint ventures, and minority stakeholding or minority interest. So there, has not been any final decision yet.
Okay, so I think in the interest of time, we move to Graham. So I think now we pick up segmentation from a regional perspective. So please, Graham.
Okay, well, thank you, Professor Danon. Good morning, good afternoon, everybody. I'll not try to repeat anything which Norman has already touched on and which Koen covered in his discussion with regard to the accounting aspects. What I would say, first of all, just to step back a little bit, is in terms of amount A, I think there is a trade-off between administrative simplicity and something which I would describe as being economically rational. From my perspective, I think in terms of the policy, I think it is important that you have something which is economically rational. Administrative simplicity is great, but if that produces a set of results or a set of attributions to the market, which really are very divorced from reality, then I think it's a false objective, shall we say. Vikram's example, I think that there are the profitability of the two different regions. They're different. They're not dramatically different, but they are different. I think from my perspective, I think there are many situations that multinationals have very, very differential, different profit patterns in different regions. And I think it's important that that option is there to allow the multinational to choose to segment. I think it's called out in the blueprint. There's obviously mandatory segmentation is touched upon. I think there's an indication that maybe voluntary segmentation could be there. Obviously, there need to be guardrails so that anything which is done on a voluntary basis, it essentially is underpinned by factual pattern, underpinned by how the business is managed, the supply chain, etc. And there has to be strong reasons for doing it. So I think, as Norman mentioned, profitability differences. Can it be an unlimited number of segments? I think that would be wholly inappropriate. And there needs to be something which essentially, I think, is stable over time, because whatever approach is followed, the segmentation essentially will need to be explained, reviewed, and hopefully agreed to by the review panel through the certainty process. I think Koen touched upon some of the challenges between using segmented financials within a company's global financial report, and I would say that I think all his comments make complete sense there. I think also it's not necessarily the case that the way in which a company reports its segments is really how it's actually managed from an operating perspective. So you may report it on a business line basis, but your business itself may well be managed regionally and could have very different profit profile by region. Now, those are all sort of big picture background aspects as to why I think segmentation at essentially the option of the multinational should be present in the eventual approach, obviously with appropriate guardrails. Now, what I would say is that any segmentation, it does carry challenges. So first of all, what are you determining here? You're determining the system profit. And obviously that means that you need to eliminate the various different intercompany profits which have been achieved as a result of the transfer pricing in terms of determining your system profit. So any profits which arise, for example, on royalties, perhaps you would need to unwind. Research and development, which in the case that Vikram laid out, all of that would, I think, be borne by the parent licensor. But in effect, you would have to allocate that to the system profit being computed on a regional level. Again, I think those things are possible. Similar with corporate overheads. You may have cross-segment transactions you would need to deal with. But I think it's possible to do it. I think that there needs to be a relatively simple methodology and a consistent methodology applied in terms of determining the attribution or allocation of costs to different regional segments. But if your business is managed that way, I think a company would be prepared to do it. Certainly from my perspective, we would be prepared to do it if it was appropriate. If it's rational, I think you would go ahead and do it. Obviously, I think, as I said earlier, it needs to be something which is done on a consistent basis. It needs to be something which is capable of audit and review. And importantly, it needs to be reconciled back to your annual report. So I think there are complexities, but from my perspective, it is doable, or at least the facility should be available for it to be done.
Yes, thank you, Graham.
Thank you very much. I will give the floor to Vikram. I realize that as we enter into this debate, there are a host of questions, and then we could discuss until midnight, but it's of course not possible. So please, Vikram, go ahead.
Yes, so the issue of segmentation will be picked up again. In this case study, we don't really have the issue of segmentation, but it's very important for everyone to know about the issue of segmentation. And the comments that have been made by Cohen and Graham will be picked up again in the next case study, which deals with segmentation. So moving on in our case study, the next issue after the tax-based determination is how is amount A determined? How is AmountA reallocated, and which entities in the group should provide relief from double taxation? So how do we calculate AmountA? So we have the figures of 200 million of standardized PBT and a 20% group margin. So in order to calculate AmountA, there are a couple of approaches. I've taken the simpler one. You remove from the standardized PBT margin a deemed non-routine margin, which is, a deemed routine margin, which let's assume is fixed at 10% as according by the inclusive framework. So 10%, because out of 20 you remove 10, then 10% will be deemed to be the non-routine EBT margin. Now this non-routine EBT margin is then actually split between is an arbitrary split between production related activities, and then there's a deemed allocation to the market. Now this is once again something which will be determined according to the multilateral negotiations done by the inclusive framework, the numbers, the 10, 20%. So in our example, since 10% is the deemed non-routine margin, 20% of that 10% will be allocated to market-related activities. So essentially, 2% of the deemed non-routine margin will be of the PBT margin will be allocated to market-related activities. So once you know that 2% is allocated to the market-related activities, then then to determine the amount A number, you would just need to multiply the 2% with the group sales, which is around 1 billion. So this would give us a figure of around 20 million, which will be up for reallocation. Now, the assumptions that I've made here is a reallocation using a 20/10 approach. So 10% being the deemed routine margin, and anything above 10%, or let's say anything above 10%, that means 20% of anything above 10% will be reallocated to the market. So 20 million is up for reallocation here. But before we show how the reallocation actually works, a couple of questions once again, and I would request the speakers to be very brief in their inputs at this stage. Question to Fabio. Should the reallocation percentages be the same for CFB businesses and ADS businesses? Now keep in mind that when you're dealing with CFB businesses, you have a lot of local presence on the ground, whereas in ADS businesses, you don't have local presence on the ground. And given the fact that you're working with an ADS kind of business, what would your opinion be here?
Thank you, Vikram. One of the main criticism around the Pillar 1 is that there are too many carve-outs. Yeah, looks like it was a race to carve out, whether it's because specific industry, or if you're a consumer-facing business or not, or also they are arguing about the local presence, or even if you have the local presence because it was not a relevant kind of local presence in the jurisdiction. So I think we need simplification, and as much as possible uniformity-neutrality between and among businesses. But I was thinking, in this context, I like one of the proposals that came out during last week public consultation at the OECD. I think it was Luis from Johnson & Johnson, which basically was going, say, let's departure from this amount A and amount B context, and let's introduce the amount Z, which is just a return on sales applied to all companies across all countries where sales occurs. Very much simplicity around that, and avoid discrimination between the industries, and very either tactical or practical approach to that. So to your point, to the specific question, I will use the same percentage. That may not be perfect, but you see, even between the same businesses, you may have different profit margins. And if you come to think about also what is rational about the AmountA, for me, it's a political decision. It's not really an economic rationale behind that. So to try to apply economic principle on something that is unprincipled, or try to use precision or something which is a political decision for not per se precise, is, in my view, not the right approach. Even the debate, if you want, on the local presence may either be addressed by some of the safe harbor discussions, but also maybe is leading the reason is saying, oh, consumer-facing business equal local presence. I think even yesterday, Jean-Louis was mentioning that Nestle operates many jurisdictions with a third-party distributors right now. So in this case, we should do also segmentation for these companies, distinguishing, you know, marketing with presence versus marketing without a presence. Now, you know, we're building up on specificity, on potential, you know, artificial ad hoc arguments. Could even discuss about the quality of the local presence, but as you said, we should be brief here. But my final comments here is, you know, it may look like there is a tendency to overanalyze and to look for an absolute ideal precision to reflect the economic reality. So at the end, the entire system becomes unmanageable. And basically this pillar one, you know, this can go and fail. And that is, I think, you know, that the alternative to that, as also was mentioned yesterday, is not anymore between pillar one and DST, but could be between pillar one and unilateral pillar ones and DST.
Thank you very much. Yes, I think we will pick up some policy thoughts on the rationale of pillar one and the feasibility of pillar one at the end of the session this afternoon. So I will not comment on this at this stage, but perhaps Graham, what's your perspective? Do you agree with Fabio?
It's an interesting question, this one. And I think it touches on the question of horizontal equity between different businesses and what is the policy rationale behind the whole project. I think like Johnson & Johnson, Procter & Gamble put forward a proposal in the public consultation. I think there were some similarities between the proposal. I think the challenge for me is if you go with something which is effectively the same. So if you use the Vikram's example and go with 20/10 for all entities, it seems to me that where you already have presence on the ground and you're already being taxed on the ground, is it meeting the objective of the policy objective of the project if the essentially the additional attribution to the market for those companies, and they could be CFB or ADS, where they have operations on the ground, is it meeting that policy objective if the additional attribution to the market is the same? Or is the intent to also recognize that where there is no operations on the ground, but there is still an ability to exploit the market, that should be looked at differently? So then you perhaps get to something closer to horizontal equity in terms of attribution to the market for all businesses. It's a policy decision. I think Fabio touched on the Johnson & Johnson proposal. I think the Johnson & Johnson proposal, the amount Z, was not actually too different to some of the proposals we had. There are some similar genesis in there. So I'll leave it at that. But I think it's a policy question for me. I think a horizontal equity issue which needs to be considered in terms of getting to a final decision.
Thank you very much. We will come back to the policy dimension this afternoon. Indeed relevant. Vikram, back to you.
All right, thank you. So moving on, so we've seen how the reallocation amount is determined, the MountA amount, which is amount A amount, which is around 20 million. So it'll be reallocated to the market countries on the basis of an allocation key, that is sales made in each region. So because 10% of the sales were being made in India, India would be allocated 2 million of the profit, and local corporate income tax, as per the Indian tax rules, will be paid on that amount. Because in Germany, there were 20% of the global sales that are being made to the German market. 4 million would be allocated to Germany, on which you will have to pay local German corporate income tax. And interestingly, this is where it's very much interesting, is that 30% of the sales are being derived from the French market. So in France, an MNE allocation would be made for around 6 million. But keep in mind that under the current profit allocation framework, which is under this current transfer pricing system, separate entity transfer pricing system, this local entity is reporting a taxable base of 5% on local sales, which would amount to around 15 million, which is, 300 million are the local sales, and 5% of 300 would give you around 15 million. At this stage, because the French entity is a full-fledged manufacturer, it could be a full-fledged distributor, it is already booking some kind of residual profits in France. So there is an overlap between AmountA and the existing profit allocation framework, in the sense that AmountA seeks to reallocate residual profits to the market country. And here you have a situation where under the current framework, the market country in France is actually, you're already booking in residual profits there. So to avoid this overlap, a marketing and distribution safe harbor is being introduced. Now this safe harbor works on a calculation, which would be AmountA plus a fixed return on local sales. Now, if the local profit under the current system is equal to or it exceeds the safe harbor, the marketing and distribution safe harbor, then no profit allocation under AmountA is being contemplated in France. And we assume this is the case here. Now, alternatively, there's a domestic business exemption test that has been contemplated. But as we've seen in the public consultation, this domestic business exemption test did not get a lot of backing. And I think the focus is more on the marketing and distribution based safe harbor. So with respect to the French operations, I will just stop here at a second, because it's very important for us to address this marketing and distribution safe harbor issue. And I would like to turn over to Elizabeth for her and ask her the question with respect to what are the core issues and challenges with the marketing and distribution safe harbor test. Now, also just imagine, Elizabeth, if we are assuming that the French entity is making profits. Now, if the French entity was in a loss situation, then an AmountA allocation would have been made and paid to France. But just assume now, in the 4 years later, after an AmountA allocation has been made, the tax administration makes an upward adjustment in France, a primary adjustment on transfer pricing in France, and then how would this amount interact with how would this adjustment interact with AmountA? Because AmountA has been made and paid in 2023, but the tax administration is making an adjustment in the year 2027. And finally, how should withholding taxes on royalties be taken into account in our example?
Thank you, Vikram. I think that was a compound question. So let me take time. It says on the slide, the issue of double counting is solved in a straightforward manner in our example, and it is because of how the numbers are set up. So our French entity is a full risk manufacturer or distributor. It's already earning and reporting a share of residual profit because it's a full risk entity, and we're told that it's making an arm's length profit. So if we allocated the full 6 million on top of the 15 million already being reported, that would over reward value in the French market. So the marketing distribution profit safe harbor says the caps essentially the amount to be earned at 12 million. So a 2% return on sales plus the 6 million reallocation under Pillar 1. So, that makes the numbers easy. 12 million versus 15 million, no reallocation. But, the numbers could be different than they are in our example, and you could end up with more of a conflict. So let's suppose that there were some incremental reallocation on top of the amount being earned in France. Now, the marketing and distribution profit safe harbor, gives a deemed return to the routine manufacturing, marketing and distribution function in France. But what if our French entity is also a manufacturer? Shouldn't if it's a full risk manufacturer, something should be taken into account for the manufacturing function as well. So, the marketing and distribution profit safe harbor doesn't really deal with multifunctional entities. And I think that's something that, would need to be taken into account in developing it further. One other challenge that I see with the safe harbor test is how does that square with amount B? Because this deemed return, we're saying that, the deemed routine return is 2% on sales. And so everything above that must be non-routine, or, it's our deemed non-routine profit that's already sitting in France. So the 2% will need to be aligned with amount B so that, this entire system makes some sense, because amount B is intended to be, what's the, deemed appropriate return on routine marketing and distribution functions in a jurisdiction. So I think, those two need to be coordinated. So those are kind of the two key challenges that I see with the marketing and distribution safe harbor. So I'll take the next question on transfer pricing adjustments. And Norman already previewed that this is a significant issue on which nobody really has an answer yet. So let's, we assume for purposes of this question that the French entity, is just a distributor and not a multifunctional entity. Working through the numbers, if there is a subsequent transfer pricing adjustment in France, let's suppose that, that transfer pricing adjustments are usually based on, they're transactionally based. So the only outbound payment from France that's reflected in our example is a payment of a royalty to Switzerland. So the French tax administration would reduce the amount of royalty payable from France to Switzerland and increase France's income. Additional taxes due. So what do we do now? There should have been, we didn't make an AmountA. Well, in this example, if there had been losses, we would have made an AmountA reallocation. And now we've had this transfer pricing adjustment and the circumstances have changed. So there shouldn't have been an AmountA reallocation. So that AmountA reallocation, let's assume in our example that it came from Switzerland. So the Swiss entity paid tax to France on this reallocation of profits. We have, now Switzerland will be asked, maybe our French entity takes its case to MAP under the French-Swiss treaty. And, Switzerland's in a position, do we give a correlative adjustment for this when we've already given up a piece of our tax base to the French under AmountA, and there's no mechanic for fixing it. There's no mechanic in the blueprint for going back and revisiting an AmountA reallocation, an AmountA allocation. And this is, an inherent difficulty. Norman said earlier that we are layering the AmountA system on top of the existing arm's length profit allocation system, but there are all these interactions between them. And I think, that better coordination needs to be had between those two systems. So last question on the slide, I would answer absolutely. So a withholding tax on royalties is quintessentially a tax on non-routine profit. AmountA involves deemed non-routine profit, but the rationale for taking into account royalty withholding taxes is essentially the same as for the marketing and distribution safe harbor. If a jurisdiction is already taxing a portion of a multinational group's non-routine profit, it shouldn't get to double dip.
Yes, but if I may add something, if the way you carve out income which has suffered withholding tax should be reviewed properly, because the amount of withholding tax is generally lower than the corporate tax otherwise applicable to an AmountA. So either you carve out the income, or you carve out, or you deduct the withholding tax from the AmountA, which is attributed to the source country. So I think that you may have a different result.
No, I agree. You're right, Professor Maisto. I think that, you know, just reacting logically, it seems like the second method, you know, would make more sense. But, you know, again, this is something that's not necessarily dealt with in the blueprint, and that adds yet another layer of complexity into an already complex system.
Okay, thank you very much. I think we will, in the interest of time, move on. Please, Vikram.
Yes, thank you. So we've spoken about the reallocation to India, Germany, and France in our examples. But now the question that we are going to ask is with respect to what's happening in Switzerland and the US. Now, if you see in Switzerland, 10% of the global sales are being derived in Switzerland. So Switzerland will also be given an MNE allocation of around 2 million. But keep in mind that under the current framework, Switzerland is also booking residual profits for the entire sales that are being made into India and Germany, and partly for the sales that are being made into France. So there are a couple of issues in Switzerland. So Switzerland, firstly, is reporting a profit of 15% on its sales under the current system, and then on top, what the question now is, should Switzerland be identified as the entity which will provide relief from double taxation for the taxes paid in India and Germany? And the answer to that is yes. So in this example, if there's any AmountA taxes paid in India and Germany, so Switzerland will have to provide a relief. Now, this relief, why are we choosing the Swiss entity? Because if you apply the activity test, which is based on the facts and circumstances analysis to see which entity has a connection, what the entity is actually doing. So Switzerland selling into these markets, or somehow there's a link between the Swiss entity and this entity. So if you apply the activities test, profitability test, and the market connection test, which is being contemplated in the blueprint, and to which Norman has also referred to, then Switzerland would be the relieving, or the entity in Switzerland will have to provide relief. So essentially, in Switzerland, there would be no AmountA liability, because you've paid around 6 million in India and Germany of AmountA. So in Switzerland, you have a 2 million liability. So you have a 4 million of excess of AmountA tax with respect to the amount. And this amount could actually be then further be reduced, would further reduce the corporate income tax base of Switzerland under the current framework, assuming that the exemption amount is being chosen, the exemption method is being chosen here. At the same time, in the US, as 30% of the local sales are being derived from the US, it will be allocated 6 million of the AmountA kind of income. But keep in mind that under the current profit allocation framework, the US entity is also booking residual profits for the American market. Now, once again, they could be you could apply the marketing and distribution based safe harbor test here, or the domestic business exemption test, and hence there would be no AmountA liability, because the residual profits that are being reported in the US under the current framework are quite substantial. Now, even if there's a AmountA liability, then the US entity would be identified as a relieving entity for the AmountA liability if it arises in the US. This is not the case in this example. So with respect to this profit reallocation and determination of relieving, of which method we should choose to relieve double taxation, Fabio, one of the questions I have for you is in relation to what are the key challenges you see in the various tests to identify the relief providing entity. So there are a series of tests. You have the market, the profitability test, activities test, market connection test, and so on and so forth. So what are the key challenges you see here in these tests?
Yes, thank you, Vikram. Look, I think if you look, the approach of a DEMP analysis, generally speaking, is fine in simple scenarios. Let's assume we are just one centralized principal or IP owner selling in all foreign jurisdictions. Then it's pretty clear that this is the entity that should provide the relief. Now, in more complex scenarios, which are more frequent, with multiple principal companies, then the DEMP analysis might start showing its limits. Also due, I think, to the high level of subjectivity in assessment of transactions involving intangible by the tax administration. So need of other indicators. That's one you just mentioning. We have the activity test, and here to do for the DEMP analysis, we use the master file, the local file, the country by country reporting. All the documents which are already available to the companies, to the corporations. And again, here I would like to make the point, we should try to avoid to create new and ad hoc documentation as much as possible throughout all the measures of the pillar. Then we have the profitability test, the market connection priority test, and the pro-rata allocation. So let's assume using these allows you to identify also the entity or entities to provide the relief in year one. But then if in year two, this entity makes losses, then under the profitability test, you need to then identify another one. So here, one of the issues also to work on predictability and certainty for taxpayer, as relevant because it also may change year to year with the test. Now, we were focusing on talking about Switzerland to provide the relief in our own example. I think somebody could argue that also US is getting some of the residual profits from foreign markets via the royalty from Switzerland. So I also may look at one as providing the relief. So as I say, those are some some of the challenges those may provide using those tests. But I think once somebody else also commented here, that's up to me.
Hello?
Yes.
Yes, so yes, there are some challenges. And so Graham, what would your response be in this case and to Fabio?
First of all, I would say I broadly agree with most of what Fabio had said. I think identification of the non-routine profit earning entities in your master file is a good start. I think this also fits with the segmentation question, right? From my perspective, there should be a linkage between how your profits are segmented. That would then directly link to the countries to which AmountA would be allocated, and also to the surrender. And I think Fabio makes a very good point in the case study, which I'm completely there with, is that in the case study, I think the appropriate approach with regard to attribution to the market of AmountA and the surrender, it should be shared between the principal Switzerland and the US, because they are both non-routine profit earning entities. I think if it's not, I think I would raise the question, if I was the Swiss Competent Authority, I may well raise the question of whether, in fact, if that's not the case, is there then a secondary effect on the transfer pricing relationship between my Swiss principal and the US licensor? So I think broadly speaking, I would say I agree with Fabio. I think activities test it ought to start, and it ought to be premised essentially the approach to AmountA starting from the sort of transfer pricing profile.
Thank you very much. So I think we can move on to the next question, which is for Elizabeth. Should countries only use the exemption method, or can the credit method also be used to provide relief from double taxation? What are the challenges you see with the credit method? Of course, this is a good question for a credit country. So please, Elizabeth.
Indeed it is, thank you. So, to the first question there on the slide, I can't tell countries what they can and can't use, but the blueprint says either exemption or credit will be allowed. And I think that's probably out of necessity because there are many countries with exemption systems, but the United States and a few others still have credit systems. And I can't see that going away very soon. Although I would add that we now have something of a hybrid system in the United States. We still have our foreign tax credit baskets and we still have foreign tax credits, but we also have a participation exemption. So it might be possible to craft some sort of exemption for AmountA. But some of the complexities that would be present for the credit method system that aren't relevant for an exemption method system, principally is that credit systems tend to have limitations on the amount of credits that can be used so that tax paid on foreign source income doesn't offset tax on domestic source income. And those limitations introduce complexities like foreign tax credit baskets or separate limitations. We have people call them different things, but if you have different slices of foreign source income and the system aims to limit the number of credits that can be used against income earned in each of those different categories, how AmountA would interact with that, I haven't the faintest idea. We also have, and this may be a uniquely US thing, but we have expense allocation. So interest expense and certain other expenses have to be, we don't follow the books and put them, where they are actually incurred. We, have a complex method for allocating them across these different baskets of income. So, those basketing, allocation, and apportionment, I think, there would also be a question, and this is related to basketing, about whether for AmountA you would grant credits sort of jurisdiction by jurisdiction, or would they be blended? So if I've paid AmountA, my entity has paid AmountA tax to this particular jurisdiction, should that be usable only against income sourced there, or would it be usable as some sort of general credit against all foreign source income? So, I think that the blueprint points out that the average tax rate among market jurisdictions is 26%. So secondary taxing rights that would be retained under a credit method system are unlikely to generate meaningful tax in residence jurisdictions. So, a credit system may prove to be far more trouble than it's ultimately worth to administer.
Yes. Thank you very much. Just a follow-up comment on this. Of course, in the international tax system, we know the exemption method and the credit method since a long time. They are based on completely different policy consideration. Exemption is really for countries that have capital import neutrality. Credit is more for countries that have capital export neutrality, worldwide taxation. We've seen also a hybrid or a shift also in the US system, because somehow with the participation exemption, you slide it towards a more territorial type of system. So the distinction is not so clear cut. What I want to ask just very briefly, because we're running out of time, to Norman is, of course, you consider the complexity and balancing exemption versus credit. And I think coming from an exemption country, I can only say that the exemption method is very, very simple compared to a credit system. But to what extent were the policy considerations, capital import, capital export, relevant when you were balancing exemption or credits, Norman?
Well, quite frankly, the discussion about the method for eliminating double taxation is really driven by the countries, and that there are two different, I would say, camps of countries. And that will be and is a sovereign decision by the country if they want to apply the exemption or the credit method, and therefore both of them are included as options in the blueprint.
Okay, very good. So back to you, Vikram.
All right, thank you. So moving on, after addressing these questions, we've covered the entire segment on AmountA, how AmountA is calculated, reallocated, which entities provide relief from double taxation. I think with this case study, we've given a very good overview to the participants on how AmountA would actually work. With respect to amount B, I would now just like to mention that amount B is also relevant in our case. especially for the low risk distribution operations that are being made into Germany. And Amount B contemplates to fix an arm's length remuneration for the limited risk distributor in Germany. In our example, it was 3% on sales, but based on a figure that will come out from a comparability study, it could be a bit different. But Graham, coming to you, because you are really dealing with Amount B structures in your setup. So what are the main challenges you see with Amount B, and how do you think they can be overcome?
So thanks, Vikram. I mean, a couple of opening comments. I think Amount B has probably had less focus on this project than Amount A. I think everyone acknowledges that Amount B is difficult, but I think I would say that that's not a reason to avoid Amount B. Yes, it's intended to essentially closely replicate the arm's length standard, as Norman said in the opening. But I think from a multinational perspective, I think this is a key opportunity to ensure that there is simplification in the system and also certainty. And I think certainty is something which is incredibly important, particularly when obviously there is going to be a potential added cost for many multinationals as a result of Amount A. In addition, one would hope that if an Amount B approach can be adopted, that's going to have a significant impact on what is a very extensive MAP caseload. So as a kind of opening statement, I would say that I think it's incredibly important to try to continue the process on Amount B and try to bring Amount B into this framework. I think that the blueprint has done a pretty good job in terms of defining baseline marketing and distribution activities. I think there's a question around, is it appropriate to limit it only to routine distribution, or should it be extended to other types of legal structures which have got similar functional activities? Because bear in mind, what we're talking about on Amount B is a functional return. I think one of the reasons why Amount B is important as well is to try to ensure that you eliminate the potential double counting between Amount A and Amount B. Not intended to be the case, because I know they come from different, there's different genesis to Amount A and Amount B, but I think we've all seen those situations apply in practice where essentially amounts which I think would fall under the Amount A concept end up being attributed to the market. Now, I think approaching Amount B and trying to get to an agreed fixed return, that's not easy. I think everyone has probably seen that comparable studies. I think if you look at comparable studies for routine marketing and distribution around the world, most comparable studies come up with something fairly similar, right? Now, the challenge though is that I think unless you get to something which is a fixed point in that, then have you really got certainty if all you come with is a broad range? I think that it would be important that you would try to get to something which is a fixed point. Are there industry or regional differences? Maybe some industry differences from a functional perspective. From a regional aspect, certainly in my experience, differences are relatively small. However, appreciate that in trying to go down this path, you would have to have a sort of international agreement on how you're going to approach your benchmarking, what the screen criteria are going to be. Is data available everywhere? So how are you actually going to get to that Amount B as perhaps a fixed return on sales? I think because of that, I think when we've looked at the overall project itself, one of our suggestions, which I think was alluded to earlier, and again is not dissimilar to the suggestion that came from J&J, was to somehow put Amount A and Amount B together and perhaps have it linked not necessarily to sales, but perhaps to profit. Now, it's obviously not completely straightforward, and that's a deviation from current arm's length pricing. But we think that it's important to get to an outcome on Amount B, important to get to an agreement on Amount B, And this to us seemed as if, given that you have one measure, amount A, which is profit-based, if the other measure, amount B, is not profit-based, do you have two things which don't totally fit together? So is there an approach that could be used which more put amount A and amount B together for operations which are essentially routine marketing and distribution? So you'd build in effectively an element of the share of the excess under amount A into your amount B where you have presence on the ground. So I think with a lot of goodwill and a lot of effort, my view is that amount B, the challenge can be overcome. It's not straightforward, but I think in the interests of getting something which is a long-term, sustainable international tax framework, it's really important to continue the work in this area and seek to try to get there. And I think it needs some creativity. So perhaps you go a little bit beyond where today standard approaches actually work. And that means perhaps a little bit of thinking slightly outside of the box with regard to the approach to the arm's length principle for routine marketing and distribution.
Okay, thank you for that. So I see, Professor Dannon, we have like 5 minutes to go. So I suggest we quickly move to the next round of questions for Professor Maisto. But before that, I would just like to show to everyone that post amount A reallocations, there would be an amount A which will be paid in India, amount A and B in Germany. There would be no amount A in France because of the marketing and distribution safe harbor test. The principal entity in Switzerland would be an amount A liability, but because of the amounts, because of the relief rules, there would be no amount A liability. Further, the corporate income tax base of Switzerland could be reduced. And in the US, probably there will be no amount A as a result of the marketing and distribution safe harbor test. So moving to the question on losses, because we've spoken about profits. Now there could be, losses can be divided into two big baskets. One is pre-regime losses before you enter into amount A, and another basket, which is once you enter into amount A, you could have in-regime losses. So with respect to determining how does this proposal deal with losses, I have the first, I would like to leave the floor to Professor Maisto to continue with the discussion here and address the question of losses.
Yes, I think I have allocated time to the topic for the afternoon as the sequence of the slides indicates, because we have only 2 minutes left, and I believe it's quite an important subject, so perhaps we can move it on to the afternoon session.
Very good, Guglielmo, indeed. So we can move on. Thank you for that.
All right, so actually I'm done with my presentation. So in the next session, when we start, we'll pick up the loss questions, and then we will move to case study number 2.
Okay, thank you very much to you all. So we did manage to finish pretty much on time. So we will begin with the next case study at 2 o'clock. And after that, we'll have a broader policy discussion. I hope you enjoyed the session. It is technical, but I think it's really fun and gives us the opportunity to dig into the consultation questions that were raised a while ago. Thank you very much, and we reconnect at 2.
Thank you.
Everyone, welcome back. I hope you enjoyed your lunch break. We're now entering the second part of the session on Pillar 1. And we will move on with the second case study that has been prepared by Guglielmo Maisto. And I guess also, Guglielmo, you will be dealing with the losses issue, which we left from the first part this morning.
Yes, indeed. Thank you, Robert. We should address first the proposal insofar as the proposal is dealing with losses. I think that is something which has been discussed also at the public consultation. And we have a number of of issues there. First of all, I would say that it is in my perspective, and here we have precisely the paragraph of the blueprint. I'm sure Norman and the others know what we are reading, and because of a debate which took place so far, I find it to be an issue relating to the balance between the source country and the country of residence, insofar as if we disregard losses of prior years prior to the mechanism of the AmountA, then we cannot use such losses to reduce the AmountA to be allocated to the source state. So I shall address some of the points, but I anticipate asking also Norman in particular, but also the others, if they do agree with my, let's say, policy perspective in the source countries being perhaps insisting for not considering the prior year losses. If we look at the losses accrued before the application of AmountA, that has to do with what is regarded to be a principle of equality and ability to pay, because has to do with situations where groups have invested in prior years and they realize profit only when they turn to enter into the AmountA mechanism. So only profits will be allocated, but the investment and the losses generated before will be totally wasted. And so source states would receive an AmountA which is not realistic. So my position is clear, and I believe that during the consultation also many of the stakeholders who were attending have, let's say, taken that position. And the second point is from when to have the loss carry forward mechanism to be taken into account, and I would find it obvious to consider that only from the date the taxpayer has to enter into the AmountA rules, and not when the AmountA rules really come into effect in general, so on a taxpayer basis. And then the next point on which I would solicit comments is on the time interval. And I believe that there are several views there. And really I could not find a realistic and a reasoned, let's say, a point on whether to use 5 years or 2 years or 10 years. I'm just quoting what, let's say, taxpayers and stakeholders have commented. I would simply say, which sounds obvious, that a period of 5 years makes sense because it's not too long, it's not too short, and in a way it looks into what we are used in many countries for tax purposes, just to say something very simple. The last point is on adjustments to comply with AmountA rules. And so would again solicit comments, especially from business. And I have one also particular point which perhaps was touched this morning by Norman when addressing the general aspects of the entire mechanism. And the point, I don't know whether he had that in mind, has to do with minority shareholders. When in the country you have minority shareholders, and so a minority shareholder in country A, which does have a 20% participation in a subsidiary, and the losses would be consolidated, the losses of of that company, namely the 80% parent would consolidate. The mechanism for allocating the previous year's losses, which would then prevent the AmountA to be attributed to the source states. How would that work in the context of minority shareholders? Because to me, that would be a loss which would be attributed to the parent, and the minority shareholder in a way would need to be remunerated overall. It's more or less what you have in group consolidation at domestic level when you have minority shareholders that need to be remunerated for a loss which is transferred to the parent. I don't know whether you looked into that. It's not so, let's say, unusual to have minority shareholders in large groups. And so that is a point I wanted to address, and perhaps have either Norman or other speakers to comment. So I would ask, we'll start from Norman first, Graham, Elizabeth, and Karen, to address both points if you have any comment on that.
So perhaps Norman first.
Yeah, perfect. Thank you so much for the introduction and the good overview. So comments from my side is really the consideration of losses is contemplated under AmountA, and that's one of the big advantages of AmountA compared, for example, the unilateral DSTs, because AmountA is really a net tax basis, or a taxation on a net basis. So therefore, so once AmountA is established, and maybe I just take a step back and just explain how it is envisaged to consider losses. It is really, so once AmountA applies and then the MNE would have a loss on a group basis, in that year then no AmountA allocation would be performed, because this loss on a group basis again would be kept separate, and only in future years, if the losses are earned out, so it's a so-called earn-out approach, and if the profitability threshold is then met in the future years, then the AmountA reallocation starts again. So I think that's no question about losses within the AmountA system. The question about the pre-regime losses, so that means losses which have occurred before the establishment or implementation of AmountA, is an interesting one. And I think you have already alluded to a little bit the negotiation. Of course, source states or the market states are arguing for not considering it or not considering it for a long period, because if you take pre-regime losses into account, then it will reduce the AmountA allocation, obviously. So there are the negotiations ongoing. If yes, for how many years they will be included. Yeah, I think that are my comments to these points.
I think what is very interesting in the discussion from a conceptual point of view is I can understand, of course, the point of view of the source state to say, well, we don't want these pre-regime losses to enter or to be taken into consideration. But of course, the tension, and Guglielmo actually mentioned it, is that of course, AmountA is an add-on, but at the same time, we're still in the range of corporate income tax, and therefore we're still in the range of the ability to pay principle. And if, of course, if you test the system in light of the ability to pay, it militates, of course, in favor of taking into account the losses. So there is obviously a tension.
Yes, and maybe one more point for the pre-regime losses. We have to be aware that many of the companies who would be under scope and who are performing automatic digital services would normally start well, if they start, they normally have, well, how should I say, they accrue a lot of losses before then they turn profitable. So that's, I would say, the typical business model. Yeah. So if you would allow pre-regime losses to come into play, then that would significantly reduce the amount A reallocation. Yeah. But that's just a point also to take into consideration.
Absolutely. And what about the time interval that was raised by Guglielmo?
Yes, I think that one of the points Robert I wanted to make is that in reality, we have groups which are profitable and which have, let's say, previous year's losses, which are geographically allocable or attributable to one region or one country only. And sometimes those losses are not even shown as a tax asset in the balance sheet, or not even in the consolidated balance sheet. Although here we are talking about a basically a review of we are talking about a review of the financial of the company. So I think that is not only the situation that you described, but also situation which would require some adjustments. Robert, you were making a comment, or Graham?
I was just alluding to the time interval, because you mentioned 5 years as an example, yes. Mirroring effectively, because in some countries under the current framework, it's unlimited, 5 years, 7 years. So I don't know about this, Norman. What's your perspective?
If you're, I think your question is to the time interval for pre-regime losses or for the losses after implementation amount?
I think for the losses of previous years prior to the entry into the AmountA mechanism.
Yeah. Yeah, I think that's still under discussion. I think the years were like, I think from 1 to 5 or even 10 years. I think something like that is discussed. Yeah, but it's still open. Okay.
So I think, Guglielmo, we can go to Graham, perhaps.
Yes.
Okay. So thank you. So first of all, I should probably say that I don't think it's our fact pattern. So I'm not speaking from shall we say, a company perspective, but it does seem to me that there is a strong rationale as to why pre-regime losses need to be there, need to be taken into account, but it needs to be practical. I think, as Guglielmo said, there has to be a balance between residence and source here, because I think the party which is invested ought to at least effectively ensure that it is able to benefit from that investment by tax being paid on the profits which come in the future. Obviously, you've got cyclical businesses here as well to take into account. A couple of things that do occur to me. So one is segmentation. Again, is a potential question because losses may be in one segment and not in another segment. So that needs to be considered. And the second point, and this may be a little bit of an esoteric point, but I think it's something that perhaps Guglielmo just touched on, is that if I think about a situation, your losses could arise where, let's say, the product is only being sold in 3 or 4 markets, and ultimately have profits where that product has been sold in 10 markets. And if you think about the allocation of AmountA, that's probably going to be based on the sales at the time at which something is profitable. Now, is that attribution methodology, is that the right attribution methodology or not? Do you only look at sales in the year in which the allocation takes place, or do you need to look at something which is over a more cyclical period? That's just a question.
Elizabeth, you wanted to comment there?
Yeah, I think Graham has highlighted some of the challenges, and they, in a blueprint replete with tough questions, the second question here on the slide, how far do we go back, is a really, really tough question. For the natural cycle of any business that starts up, they typically will have losses in the first year or two at the very beginning. And that's true, across, really across industries. ADS businesses, as was pointed out, tend to accrue very large losses in one or, a few jurisdictions over a period of time, and then start realizing, substantial profits. So, when we think about how far to go back, are we trying to capture the life cycle of the business, or are we simply trying to capture a business cycle in the sense of, the economy goes up and down. Right now, companies are experiencing COVID-19. That has been devastating for large sectors of the economy, far less so for others. But, if the AmountA system were put in place from 2023, as was envisioned in our earlier case study, companies that had experienced substantial losses in very recent years might then be faced with, paying an additional tax on top of their regular corporate tax. So there's some sense of, the ability to pay principal, fairness in terms of taking into account prior years. But, how far you go back is will be a very difficult question to answer. I think, one point that's raised in the blueprint that's not raised here is, and that I think source countries would raise, is if we're going to take into account some pre-regime losses, well, why not pre-regime profits? How conceptually do we make this work and make it balanced? So it is a tough set of questions.
Yeah, well, but the previous year, there is a consistency in taking previous year's losses and not previous year's profit, because I think that the cost incurred in the prior years to generate profits is more difficult to find situation where income is generated losses after. So basically, it is quite logic that if you incur costs which generate profits in later years, you need to take them into account. As to startup, which you mentioned, I wonder whether it is something which really works if you have a short time interval, because of this reason, that when you have a startup, if you take a 5 years or even less, as someone suggested, a 3 years previous year's losses, and you have a startup, I hardly believe that you may have a startup which in 3 years is reaching a level of turnover or a level of profitability which trigger the application of AmountA, if you're looking at the real startup. So I think more about groups which for some reasons have incurred losses either geographically or in certain businesses which are all in scope businesses. So the example of startup perhaps might be considered, but only to the extent that you have a long time interval. If you have a short time interval, then you are not catching, let's say, the losses of a startup, because it's unlikely that the startup would generate a huge amount of revenue in such a limited period of time. I don't know whether you have taken that into account. I don't know, Fabio or Cohen, if you wanted to add something on this.
Quickly on my side, I think I do agree on what's mentioned here, also mentioned by Graham from a just really business perspective. It makes the whole sense in the world to consider the previous year's losses. And for the carry forward period, as you said, there are many different periods mentioned there. 5 years seems a kind of a reasonable one, also based on what we have under the normal carry forward positions. So I'm in favor of that.
A similar problem, and we can turn the slide, a similar problem, and here we are, let's say, widening the scope of groups which may have an interest. So not only groups which are having losses, but we are looking at groups which in some years they meet the threshold for the amount A, so they have a level of profitability which is set at least at the minimum provided by the mechanism which permits a part of the extra profit to be allocated. But in some other years, the same group might have a deficiency, so a level of profit which will not meet the threshold. And here, I think the blueprint is putting the issue forward by saying whether the same mechanism of the losses carried forward would have to apply to the profit shortfalls, and so that any deficiency one year could be used to offset extra profit in later years for determining the amount A to be allocated to the source state. Because of time constraint, we can put the comments together. We comment to the next slides, which has to do with what we have discussed so far, namely whether the amount A losses should be reported and administered by a single entity in the group. And here I think that I would pick what Graham indicated about the need to adjust the amount of losses carried forward, especially when they have to do with either businesses which are not necessarily in scope, or when they are geographically allocated to one particular country. And if that is the case, then I would find desirable to have the possibility to administer the losses at the level of a single entity in the group. Although many commentators have taken the view that for, let's say, to facilitate the administration, one entity only should basically manage the losses carry forward. I think that in some situations it would make sense to have the administration made at the local level as well. I don't know if there is any comment on this particular point. And if not, I think we can move to the case study. And here, basically, the case study has to do with the automated digital service. And we have developed the case study in order to have three areas to be addressed, namely the size, the minimum size threshold, the segmentation as a second point, and the foreign source threshold. And here is very simple. We are departing from the case study of this morning, and we are in the digital business. And the business model here is very simple. We have a parent company, and we have a headquarters of the MNE in the US, where main functions are performed, from product development to sales of standardized and customized cloud services. And we have two businesses which are conducted. One is in scope, which is remote sales of standardized services, and the other is out of scope services. And so we have precisely the situation where a segmentation is required. We have some numbers also, just to make an example, so we can turn to the next slide. And we have sales of $1 billion for the standardized cloud services, which is in scope. And we have 250 million sales for out of scope services. The overall return on sale is 16% and is in the amount of 200 million. So we have a total consolidated revenue of 1,250,000,000, a consolidated profit of 200 million, and a return on sale of 16%. And we shall see later how that return on sale can be used in the segmentation process. So the first issue that has been debated and we want to discuss here is where to set and how to determine the overall size threshold. And if we turn to the next slide, is something that the OECD blueprint is addressing, and there is a sort of proposal to set the threshold at 750 million. Why that amount is the amount for the country by country reporting, and that is the reason for which is included as a proposal. If we stop here for a moment, I think I found interesting the table that is shown in the blueprint book, I would say, report, which basically says how many groups would fall into the AmountA mechanism depending on the revenue test, on the revenue threshold. And if I look at 750 billion, so if that threshold were to be taken into account, then the estimated number of MNE which would have to be administered will be in the range of 2,300 groups. And if we have a 1 billion global revenue, then the number of MNE to be administered would go down, but not so much. It will be in the range of 2,000 multinational groups. Now, I believe, but that is my personal opinion, that one would need to start, because of the difficulty of a mechanism, with what I would call a pilot project, namely with a limited number of multinational groups to be included in the AmountA mechanism. Some countries have taken that approach in relation, for instance, to cooperative compliance programs, which require quite an intense time-consuming relationship with the tax administrations, and also a strong organization within the relevant groups. That is one reason for that. The second reason, in order to have a limited number of groups in the first 3 or 4 years, is that tax authorities have limited resources, and already now on bilateral APAs or unilateral APAs or MAP, we have difficulties in managing these procedures because of a limited number of people and staff by tax administration. Now, what will be happening if, as from 2023, we were to have 2,300 groups to be administered by tax authorities in the AmountA mechanism? We have to consider not only the large groups which are within the mechanism, but also we have to consider all of the other groups which are either out of scope or have a lower revenue threshold, but which nevertheless need to have access to the services of tax administrations. So my inclination would be to say that, looking at the table that was published by the OECD, I will start precisely from the 10 billion, which euro or dollars, I don't know, I think it's euro, 10 billion euro, which is precisely, if I am speaking about my country, the amount which more or less is the size of groups, which is the threshold which is requested in some countries for the cooperative compliance program. For information of the audience who doesn't have the table in front, the 10 billion would mean that 350 groups would enter into the mechanism, and 350 would find it reasonable, something which is balanced and can be administered by tax administration. So that is basically my own view on this particular point. And so I would ask views of the other speakers, and Robert as the chair, if you have any on those.
So I will perhaps give the floor to the speakers. Any views on this? Anyone would like to comment?
Yes, I can start by commenting on this. I personally think that before we talk about thresholds and before this is actually implemented, where in the way the OECD wants it to be implemented, I think capacity building of tax administrations is absolutely essential, in the sense that all tax administrations where of a lot of countries, of all the countries which comprise of the inclusive framework, they need to be trained on how these proposals are actually going to be implemented. So before the implementation of this proposal. So if the if this approach is taken and tax administrations are trained on a proactive basis on how the AmountA proposal is going to be scaled out, then probably I think as a starting point, the 750 million threshold could be a good starting point. And in fact, I would say that over a period of years, this threshold needs to be dropped down. It shouldn't be increased. It should go down lower and lower over a period of years, or from maybe after a couple of years, it should drop down to like 600 million. Then after that, 500 million, so on and so forth. Once the tax administration is aware about how do you go about implementation of these rules. But that's my own personal perspective.
I think there are two issues. One is the thresholds, and the idea of dropping the threshold. We can park this element for 1 second. The other suggestion that was made by Guglielmo, I understand, is to start with a couple of MNEs, right, Guglielmo?
Yes, yes.
Yes. So I would like to hear your thoughts on this particular points.
I think it definitely makes sense because, well, this pillar is quite complicated. It's not to be compared with country by country reporting, where they have a kind of similar threshold. So it will require time to improve the system, I believe, even if it's well taught, and it will be well taught before it's being introduced. The actual implementation will give much more learning points throughout time. And then from that perspective, it's indeed best to start with a limited number of major companies, which also I would say, will bring the most revenue in the purpose of Pillar 1. And that from those implementations, a lot is learned to bring it further, to enlarge gradually then the companies that would be falling under Pillar 1. So definitely also with a pilot case where companies can learn, where tax administrations can learn from, and then make an evaluation and improve, and then get it at a large, let's say, enlarge the scope for countries that should follow it.
I'm inclined to agree. I would like to pick up again on the analogy made by Guglielmo with cooperative compliance programs. But don't you think, Guglielmo, it's a bit different than with cooperative compliance programs?
The reason why I make a reference to the cooperative compliance program is that the cooperative compliance program, at least in my country, but I think it's probably also in other jurisdictions, and I think we have many of the people around this, let me call table, around this table, many of the people have experience with that, requires quite a time-consuming, let's say, procedure, and also it requires the group to have a quite strong or tax organization within the group. So you need skills, you need a strong organization, and for that reason, countries, many countries which have introduced that mechanism in order to face the, to meet the expectations of the group and provide a good service, so to speak, have decided to apply, let's say, that mechanism only to a limited number of groups, groups which were selected primarily by referring to the revenue, on the assumption that the bigger is the revenue, the more organized is the group, which frequently is correct. And then they have decided to expand the eligibility of the groups over time, when also the tax administration had taken familiarity with the entire system. So I agree that the corporate compliance is different from the AmountA mechanism, but in terms of, there are similarities insofar as the complexity and the need also from the side of tax authority to have a strong organization suggests some, let's say, slow move of the entire system. We also have, I also have to say that I'm trying to visualize the people who would administer this mechanism in my own jurisdiction, but also perhaps in other jurisdictions. Mm-hmm. Precisely which offices could do that? How many people in the tax administration would be able to administer from day one this mechanism? If we are talking about 2,300 multinationals, which is the number of groups which will be administered if we select 750 million, I don't think you can administer this system with a tax auditor, with all respect, who is used to make audits to a local entity. I think you need the top people in the country, and the top people in any jurisdiction are not so many. I don't think that you have more than 50 or 100 people in the best and biggest jurisdictions who might be able to get into the intricacy of this mechanism from day one without creating problems, so as to speak. And the same, so I think that is very important, and I attach much importance to where we set the threshold. And I think that MNE should also insist on that, because the lower the number, the better service they get, and also the smaller ones should insist, because the smaller the number, the better service they get when it's their turn, when the number of eligibility entities should be bigger. I don't know if you agree with that.
Yes, I would like to ask perhaps Norman to comment on this, on, let's say, this sequence of events or roadmap, the idea of having an application that is basically targeted at a group of multinationals first, and then secondly, the idea of decreasing the global revenue threshold. How is this would you think would be perceived in the inclusive framework?
Yeah, thank you. No, that has been discussed or proposed, but what are we talking about? About these thresholds, and in particular, the first threshold, the global revenue test. That's simplification in practice, basically, right? Yeah. So these thresholds have been proposed to keep it manageable and administrable. So there are, as it was discussed, these calls for, okay, we should set a higher threshold and phase it in and then lower the threshold just to keep it manageable. But for the sake of completeness, there are also calls, and in particular, we've seen that in the public consultation from NGOs and developing countries to lower the threshold. So there are these two points of views, and it's, as always in the Pillar 1 negotiations, a balance has to be found. And the 750 million, which is discussed in the blueprint, is simply coming from, as it was said, by the country-by-country reporting, because it's MNEs have experience with it. It is supported by an economic assessment, which was referenced. So it is, at the end of the day, again, a negotiation between the countries where they want to set the threshold. But I just wanted to make clear that there are voices who are asking for a lower threshold as well.
Because country by country is not a good, let's say, yardstick, because country by country, correct me if I'm wrong, is something which would not require work by the tax administration. Country by country reporting is simply a burden for the group. You don't need to interact with tax administration. So if a question is how many more people within the tax administration need to work because of a country by country reporting, I don't think there are very many. But if you are asking me how many people need to work on the AmountA mechanism, then I think the number will be huge. I don't know whether you see the point, but with 750, you could put 500, 400, you will not have increased the number of tax officials working on it, because they just sit there and look at the multinational preparing the country by country. But here is totally different, because the more you lower the threshold, the more tax officials you have working on it.
Yeah, I see the point. I would slightly disagree, because the country by country reporting is used by the tax administration, right? They use it as a risk assessment tool. So every country by country reporting which is filed is also it's also used and analyzed by the tax administration. So it's not only the MNEs, but
should be. Yeah.
But I make a joke. Partially a joke. When I read an opinion written by an associate in the firm, I take less time compared to when I have to write it from the very start. You understand what I mean? So, in other words, to read the work done by somebody else takes much less time compared to when you have to administer a mechanism like AmountA, which would require, in my view, more work compared to the use of the country-by-country reporting. I understand it is easy to make comments when you need to find a compromise, because there are several constituencies, and so you need to accommodate different requirements, but I understand entirely. So
I will turn to Graham for a few comments, but just I like your analogy with the associate. I would just make a small footnote. It depends how good the associate is.
Okay. Because the comment here is that also that if you trust what the associate wrote, right? And that maybe when you look at the country by country reporting, the tax authorities may take also a different view. Can I make a couple of comments also on what, from a business perspective, on what
yes, please go ahead.
Here? I think in terms of the threshold, the 750 million, I agree that is something that is, is used, is accepted and acceptable. So I think it's something that's good to start with. With respect now to increasing the threshold and the analogy with the cooperative compliance programs, there are other countries which have a much lower threshold to access the cooperative compliance program has also been extremely successful. So I'm not really sure that it really depends on the amount of taxpayer that access the program. It's also about the efficiency in the tax administrations, and that's also different. This is different to the efficiency within the multinationals. I think what also we should careful here is to avoid discrimination or ring fences of specific industrial groups of taxpayers as an initial point on the use of the Pillar 1 or the AmountA, and also take into consideration there are some revenue expectations, also revenue targets from the tax authorities in the adoption of a pillar. So I'm wondering whether by reducing drastically the amount of the companies initially included, whether that would result in not meeting those expectations and therefore in adoption of other different or parallel measures in the time being while waiting that the Pillar 1 goes up in scale.
Okay. I think, Graham, you also had some comments.
Yeah, I mean, look, I understand all the points that have been made and the different points at issue here. I think there are a number of factors that also need to be considered, which I think build upon what Guglielmo said, which is we need to remember that there's a lot of new things here. So you've got concepts such as segmentation, elimination of tax, the attribution to the market, tax certainty, the panel. And it seems to me the more and more taxpayers you have in there, is that would seem to put a lot of stress on actually putting in place the administrative systems to allow this to work. So maybe it should be a higher threshold to begin with. I understand the perspective from the developing countries. What I would also say in connection with that is that you obviously need to look at the question of how much potential revenue there is versus cost as well. So is there really net, how much additional revenue actually would go to certain markets versus the cost that would be there of administering the system, whether it be in the country or whether it be for the multinational. So I think you always need to look at the sort of net benefit as well. I recognize there's multiple sides to the equation, but I think it is something that ought to be looked at as to whether, in fact, perhaps a higher threshold, I'm not sure it's as high as 10 billion, but a higher threshold should be perhaps considered as this gets underway.
Thank you very much. I think we can move on.
Yes, and another point, and I would go back for a moment, just if we go to the previous slide, I think we have another point which to me doesn't need too much of a focus, at least from my perspective, because yes, consolidated financial statement, if they are a solid reference for applying the global revenue test, I would say yes. Obviously, there are always, let's say, special situations which require adjustments, but in principle, I would be in agreement with taking the consolidated financial statement as a basis, with all the caveats that have been also being addressed this morning by Norman, I think, on the differences that we may find between the different accounting principles which are applied by different countries. So I would move on unless someone wants to make comments on it.
Yes.
And, yes?
No, so we can move on.
And so the next point is the foreign source threshold. And here, basically, I have one comment and one question to be discussed on where to set and how to determine the threshold for the de minimis foreign source of in-scope revenue. And basically we have three alternatives, at least these are the alternatives which been identified during the discussion and in the blueprint, namely the resident of the headquarter or the resident of the parent company. Obviously, sometimes you may have the headquarter and the parent company being in the same country. But in the example that we have identified for the case study, we had the headquarter in the US and the parent company in the Netherlands. And so that is a situation that you may find. And or you may have other. Why I say other, and that is something which maybe is of interest, because perhaps is more, one could consider not necessarily the headquarter or where the parent company is based, terms which require also to be defined, but perhaps more logically, as we are talking about an amount A, after all, where the strategic function are located, where the risk and the intangibles are located, which do not necessarily coincide with where the parent company resides or where the headquarter is based. So that I think is a question which does arise, and I don't think that a firm decision has been taken on this point. I don't know whether any progress has been made on this point.
Norman.
No. So basically, when it was written, it was really keeping in mind the simple case. Really, you have a domestic business with a headquarter and parent company in the same country, and the idea to take of this de minimis foreign source in scope revenue test is really to take these MNE groups out, which only operate in one country, because if you run the whole determination and reallocation of amount A, you reallocate to the same country. So that's the idea of this threshold. Of course, these questions which have been raised, that there's a difference between maybe the headquarter and the parent company, they need to be addressed. But one point I want to mention, which we have to take into account, is the revenue sourcing. So even if you have a country who has only book income and profits and revenues in one country, it could be that it serves globally, remotely other markets. And then this foreign source in scope revenue test should be applied after applying the revenue sourcing rules, which are allocating the revenue to the market jurisdiction or where the user is. So that's, I think, an important point which we have to take into, well, which sometimes get lost.
Thank you.
Yes, so Norman, just based on what you mentioned, so if we have the example where we have the Dutch parent with the US headquarters and sales are being made outside the US. So in this example, you know, assuming there's a lot of foreign revenue coming in outside the Dutch market, so I guess here you would see the application of the rule from the Dutch perspective, the Netherlands being the home market, because, you know, the consolidation will be done at the Dutch level, not at the US level. So anything outside the Netherlands would be foreign in scope revenue, right? That's my understanding. Yeah, you're on mute. You're on mute.
Yes, potentially. Huh? It's still up how it exactly would apply. But yeah, I personally would agree to that analysis.
Okay, further comments on this? No?
Good. Then, if there are no other comments, I go to the last issue. I think it was partially discussed this morning on segmentation, and I would expect, especially Graham, to I think he mentioned something this morning, but and segmentation, I think that the real point is on what is called exemption from segmentation, which in my view does not mean that there is no segmentation, but is a simplified computation of the amount A, and namely that one would apply the pro rata rate of return on a consolidated basis to the in-scope revenue. So in the example that we have in our case study, where we have a consolidated revenue of 1,250,000,000, and we have a consolidated return of 16%, then as we have $1 billion of in-scope services, then the simplified approach, what is called exemption from segmentation. So exemption, I would say, from a precise segmentation would be to say, I apply the consolidated return on sales, which is 16%, to the in-scope services revenue, which is the 1 billion. And that is something which is simplified, would be easy to be applied, but obviously create something which is unbalanced, distortions, when my return on sales is very different from if I compare the rate of return on out of scope compared to the rate of return regarding in scope. So someone said, not only someone, but many stakeholders and commentators said, why not having that as an option for the groups to opt for to step out from the simplified mechanism when the simplified mechanism makes it such that the result will be a distorted result because of a huge or relevant difference in rate of return on sales on in-scope and out-of-scope revenue. And others have taken the view to have a mandatory segmentation as a stricter and more rigid approach. I find, let's say, safe harbor to be reasonable. I believe that segregating, so segmenting, is a very difficult job. It's a very difficult exercise. So to permit large groups to use a simplified approach with an option to shift into a segmentation only when that is strictly necessary makes sense. I don't know who made resistance on the simplified approach, whether it was source states or more, let's say, certain groups which had issues in applying a simplified approach. That is something which honestly I haven't looked at, namely to understand where resistance to a simplified approach comes from. And perhaps I would say Robert or Norman.
Yes, I think maybe Norman, we start with you.
I just have one point here before Norman begins, if you don't mind, because we are in a very interesting situation here. Because if I just go back to the facts of the case, if we don't do segmentation and we apply the safe harbor, then the return on sales is 16%. So your AmountA tax base would be 160 million. But if we do segmentation in this example, then we would come up with the profit margin percentage of around 20%. So the AmountA tax base would have been 200 million if we did segmentation in this case. So by applying the safe harbor, we are somehow allocating less profits to the market countries in this example.
We did it on purpose.
Yes. So you're allocating less profits to the market countries. please, which I find a bit special here, but I would like Norman to comment on this against this backdrop.
So the question is this the price of simplicity?
Yes. 400 million, sorry, in our example, 40 million, price of simplicity.
Yes.
Yeah, I think you boiled it down perfectly. Yeah? So every time there is a simplification proposed, then there are concerns from different groups. And here it is segmentation. It is acknowledged that it's going to be very complex, not only for MNE groups performing it, but also for tax administration who needs to verify it. And therefore, really, the idea was, okay, we have an exemption or a safe harbor, so we make it only mandatory, the segmentation for big, significant MNE groups. And if you're below, you can apply the group profit margin, unless there are like material distortions because of different profitabilities of different business areas. That's described in the blueprint as these hallmarks. But there was the question who is against this simplification, and I would say I would pass the word to Graham, because I think what I heard concerns from the business community, not so much from countries, if I may.
Okay. Well, okay. Well, thank you. I mean, I guess I'm speaking from a perspective which is much more along your material distortion question, I think, Norman. So, I mean, I think that without the facility for segmentation, where there are material distortions, I think that you end up with an approach to AmountA, which, from my perspective, would fail the sort of economic rationale test. Now, as I said earlier, obviously, you need to make sure that you don't have too many segments. And I think there probably should be some sort of safe harbor in both directions, which said that if the difference is within some sort of narrow threshold, then A, you're not permitted to segment, or B, you can follow the safe harbor of effectively using a group profit margin. Now, how you define that and what the differential is in profitability, I'm not sure, but presume that there must be at some point a sort of line to be drawn where it doesn't make any sense for a company to opt for segmentation because there isn't a material distortion, and at the same time it doesn't make any sense for it to be mandatory because the material distortion from a tax administration, from an allocation of revenue perspective, is so small. But I think where that line is, it's obviously got to be pretty tight, I think. But I mean, if I come back to, I think in terms of the application of AmountA, I think there is always going to be a trade-off between administrative simplicity and something which is economically rational. I would always lean on the economically rational side as being more important than administrative simplicity. But there's definitely a line to be drawn where it shouldn't go too far to one versus the other.
Okay.
I also agree with the fact that, well, being under a particular threshold of revenue, so X billion euro, let's say, to apply a simplification rule, but then making that simplification rule, I would say, mandatory especially for companies where there is a huge difference in profit margins between the different segments. That's not really aligned with the economic rationale, as Graham pointed out. So I think we agree that, generally spoken, if there are differences with profit margins between different segments, the segmentation gives the most accurate outcome. So why would we then deprive companies that just, let's say, do not apply segmentation just because they fall under a particular threshold, to not have that option? Of course, there is a price related to it, because you could reasonably assume that MNEs would apply segmentation if it is in their benefit. So it's also a policy choice, but just from an economic perspective, it would make more sense to have the safe harbor for those companies that fall below the threshold.
Okay, further comments? No?
Well, I think I'm done, Robert, and
Okay.
just in time.
just in time. I think we have a little while now, perhaps to have, as we plan, a more policy oriented discussion. So I would like to perhaps give the floor to you all in sequence on a couple of items. I think one element that has emerged from our discussion is the complexity of the system that, of course, is mitigated by various safe harbors, but still it's there. So I think maybe I would start with two questions. The first question is, do you think that the Pillar 1 project overall is feasible? If so, under which condition? And the second item that I would like to address, and that we discussed also a little bit in the preparatory session, is what is the justification for the allocation? Is it a principle-based solution, or is it a policy discussion? Is it a political discussion? So maybe we start with the first, perhaps more concrete questions. Do you think the project as it is feasible, or it requires further, to a large extent, simplification, or even something completely different? So maybe we start with you, Guglielmo, because you just ended, then we can go to the next members of the panels.
Who?
You.
Okay, I do it. Yes, I think it's, I've changed my view in a way over time. And after the blueprint, I think it's feasible, and it's very difficult to predict, because we have basically several, let's say, variables. The first one, I believe, is the US position. And then we have also, from the European side, we also have, let's say, some work being done by the EU institutions, especially on digital service tax. So that makes, in my view, an agreement for the success of the AmountA more likely to happen, because the EU is going to do something if nothing is happening. So that might be an incentive for other countries to find a common solution. But in addition, we have, nobody wants to have a friction with the US, also because of the trade issues, which have turned against some member states of the Union. That is an additional point. And third point is that if we have, let's say, an AmountA mechanism which is limited, at least in the first phase, is limited to a small number of groups. So if we have, in the discussion we had earlier, a limited number of groups, then the chance of success would be easier to be achieved. And who knows, perhaps everybody would be happy. We would just stop there, and everyone would forget about AmountA, except the 350 groups which are in it, because politically the issue will be over, those countries would be happy, and they would move to the next project with, again, you know, some revolutionary approach which goes in another direction. Because everyone is expecting something to be done, and even if you do it in a small dose, that will be sufficient to move to the next page. So I am in a way positive, and I think that will be also an acknowledgement of the work, tremendous amount of work done by the OECD. It would be a pity to waste all of what he has done. And I also want to take the benefit of what I have studied in the last 2 years. So I don't want to waste it. So
no, I'm gonna give Vikram the floor now, just on a related item. I tend to concur with you. I mean, it is a very complex. Well, I will take first an academic perspective and then a practical one. I think from an academic perspective, of course, it's very interesting because, as we said earlier, we had the separate entity approach and the arm's length principle as we know it. And this is something revolutionary. Now, like every revolution, it's complicated, like it's like a cure. You have to find the right dose, you have to fine tune it. So it is complicated, but at least, and that will basically allow us to transition later on after I've given the floor to everyone on this first item, to the next question is it justified? I think one element of justification that I see in this project is, of course, that we're staying in the range of corporate income tax with some things that are consistent, such as the ability to pay, and in particular, the principle of net taxation. That I think is important to lay the ground. Then the separate item, of course, is the feasibility, and I would like to, of course, hear the panel commenting on this. Now, perhaps to Vikram, I just ended my last comment of speaking of net taxation being a consistent principle in corporate taxation. I think that is a nice way for you to say a few words on the UN proposal, which basically starts from a different perspective.
Which proposal?
The UN, the United Nations proposal.
Yes, so I will just quickly go through the UN proposal. If you don't mind, just give me a couple of minutes. So the UN proposal, as we all know, does not follow the net-based taxation approach. It's mostly a gross-based taxation approach. And there are many issues with the UN proposal, and I see the acceptability of the UN proposal to be really non-existent. If you just start with the conceptual base of the UN proposal, it's really in, the way it has been written and designed, it's much more in favor of developing countries, and the OECD member views have not really been reflected. If I make a parallel comparison with AmountA of the Pillar 1 proposal, then in the Pillar 1 proposal, we clearly see that there is some kind of compromise, that is being struck between both developed and developing countries, which form a part of the inclusive framework. Now, in the UN proposal, it's a narrow scope, applies only to ADS. In the OECD proposal, it applies to ADS and CFBs. And in fact, by being applicable to ADS and CFBs, and then, starting with a higher threshold and then phasing down that threshold over a period of time, there would be much more in-scope businesses which would actually mean more profit allocation to market countries. In terms of thresholds, the UN proposal has not any thresholds. So even if you have eBay, which makes a $1 sale into a developing country market, eBay will have to start registering in a developing country and start paying taxes even on $1 of income that they make. So there's no threshold that has been suggested in the UN proposal. And when I make a comparison with the OECD work on Pillar 1, there is a global revenue threshold, local revenue threshold, and the OECD has indicated, what are the different thresholds and what are the implications of choosing one threshold over the another. And this is what we've been discussing on the MNE Group threshold, starting from big and moving down to small. On the profit allocation side, the UN proposal is gross-based. It follows a gross-based withholding tax approach, whereas the the OECD proposal has a net taxation approach with an inbuilt loss mechanism. And somehow with this advanced tax certainty mechanism, there is a guaranteed collection of taxes by market and user countries under the OECD proposal. The UN proposal also proposes a net taxation kind of approach, but which is optional for the taxpayer. But it's a bit bizarre because there's no guidance that has been given in the UN proposal on the entire discussion of pre-regime losses or losses in a particular year, as well as points with respect to segmentation. So the UN proposal doesn't really discuss all this stuff. It's just a hard and fast rule that has been developed, I think, in a couple of weeks, and they just flushed it out in the public domain. On the revenue sourcing side, and I think this is one of the biggest challenges of the UN proposals, the OECD's proposal on AmountA, they have like solid revenue sourcing rules. There are some issues in them, I acknowledge that, but these sourcing rules give developing countries the taxing rights over a lot of ADS businesses. So you just imagine a situation where BMW is is paying Facebook to advertise, or Facebook or Google to advertise on the Indian market, to users on the Indian market. Under the UN proposal, India cannot collect any taxes on this. Whereas under the OECD proposal, yes, India can collect an AmountA allocation. So based on the way the revenue sourcing rules have been designed, a lot of ADS businesses will not really fall within scope in the UN proposal. Another example is if you take Booking.com. If we have Booking.com in the Netherlands, and then we have, let's say, a person resident in Switzerland, which is logging on to Booking.com in the Netherlands, and they are booking a hotel in India, then in this kind of situation, under the UN proposal, India cannot tax because there's no payment that is being made from India. Whereas under the OECD's proposal, India would get an allocation of an AmountA profit, assuming Booking.com is in profit. Then the UN proposal, where it really fails, is that it has no tax certainty component built inside it. So you stay within the existing framework. You still have to go for fights with the tax administration under MAPS. So there's going to be a lot of dispute, and the way the proposal has been written right now, it's very basic, and it leaves a lot of open questions, or a lot of questions which are open for interpretation, income characterization issues, so on and so forth. Whereas the OECD proposal is backed by a tax certainty mechanism. And finally, I would just like to stop with this, is that the UN proposal is mostly bilateral in nature. So I really fail to see how a country like the US or even other developed countries in the EU are going to agree on this proposal. Whereas the OECD's proposal, on the other hand, is multilateral. And it really advances the international tax debate, which from an academic standpoint is just fascinating, as Professor Dannon mentioned. There are practical hurdles to the OECD proposal, but I think these proposals, the hurdles can be overcome. So over to you, Professor Dannon.
Thank you very much. No, so I would like to go back to, of course, Pillar 1 and the feasibility issues. Perhaps ask Graham and Fabio for wrap-up comments on the feasibility. What do you see as being the main challenge? Perhaps first you, Graham, and then Fabio.
Okay, thank you. I mean, first of all, I'd just like to echo the words from Guglielmo to, I think, congratulate the OECD on the work that they've done. I think there's been a lot of progress made. I think I'm optimistic. I'm optimistic also with the sense that I think it's important that this project does come through to a conclusion to provide certainty for the international framework in the future. Now, having said that, I think it does need some simplification, but in connection with that simplification, I think I would go back and just re-emphasize something I said earlier, that I think that we cover the concepts both under AmountA and AmountB, and don't leave AmountB there sort of hanging. Because to me, without AmountB, you're not going to have certainty. And that, I think, was one of the background aspects to the suggestions that we put forward in terms of linking A and B. It might look like it's a completely different approach, but I think in reality, it's intended to build on the work which has been done, the concepts which have been developed, and to seek to try to hopefully put something in place which Right? You may not think so when you first look at what we suggested, but I personally think potentially it's something which could be seen as being simpler and more sustainable, because I think without having A and B linked together, I think that we will not have something that is really going to be sustainable in the future. The questions are not going to go away. So I think we need to try to keep this moving. I'm optimistic. I think it's feasible. It may take a little more time, but I think I'm positive with regard to it. Thank you very much. Fabio?
Yes, thank you. I also want to commend the work done by the OECD. It's a tremendous effort, and and very good results and progress have been done. And I'm optimistic that we can achieve with the Pillar 1 the cure, as somebody just mentioned. But considering the widespread of the countries involved, I think this is a kind of a pandemic. And to cure a pandemic, as we all know these days, you need widespread vaccinations, and not only limited only to few individuals. So that would be my comment here. Also, because if we consider what is the alternative, in the past we were saying, oh, if this project fails, the alternative is unilateral DST. And I think also, as we said yesterday, the alternative is not Pillar 1 versus DST, but it's more Pillar 1 versus unilateral Pillar 1 forms and DSTs.
Yes, no, I would like to echo this. I mean, the OECD proposal is the only multilateral solution, potentially multilateral solution under the table that is currently capable of basically switching off or securing the debate. So I would really echo this. Perhaps, Kern, I don't know if you have any comments.
Yeah, so a lot has already been said. I also, well, when reading the blueprint, it's indeed an impressive document. So a lot of thought and work has been given on it. And yeah, if you just think about the alternative as already being said, it can only be worse for the global economy. We would think so. That's, I think, the main reason why there are fair chances to come up with a Pillar 1 and Pillar 2 at the end of the day, apart from all the political discussions. So thinking just about the alternative will probably get us over the finish line. That's at least what I hope. And of course, there are some open items, but yeah, as you just mentioned, it's quite revolutionary, not so revolutionary that it sets everything upside down, because the main principles in international taxation, or quite some of them, like the arm's length principle, are still applicable. So it's a layer on top, I would say. So, but it's still revolutionary, and it needs time and effort to further think about. But with a pilot project, some learning points, some improvements, I think should be feasible. Yeah. Or hopefully, we all hope that.
Well, I think it's a good time to turn to Elizabeth with the US framework in the background.
And let me pick up your pilot project metaphor and say, I think that we may get off, Pillar 1 may get off the ground, but we still have a fair bit of runway ahead of us. I think the change in the Biden administration, and I'll start on a positive note, there will be a shift in tone from the United States. The administration already includes some BEPS alumni, people with experience of successful collaboration at the OECD. Mark Mazur was just named the acting assistant secretary for tax policy. He served, as an appointee in that role under President Obama from 2011 to 2016. So same personnel who helped, bring BEPS to fruition. I think it is probable that the safe harbor proposal will, make its way to the door. But, as a reality check, there remains real ambivalence among US business about Pillar 1, at least as designed. And, at our Senate confirmation hearing, Janet Yellen, who's our new Secretary of the Treasury, pointed out that she said the US will engage in the OECD process, but will protect the competitiveness of US business. So I think, America first may not be shouted quite so loudly, but I think, you know, it has always been so that the US, you know, looks out for the interests of its own business first. So I think that will continue to be true. You know, President Biden has an overflowing in tray. He is prioritizing COVID-19 relief, an infrastructure bill. International tax issues are not likely to be a terribly high priority, you know, except to the extent they maybe raise revenue easily to pay for some of these other initiatives. And we, you know, when I'm talking to colleagues here in the United States about Pillar 1, they always raise kind of the end game piece. So there's political agreement, you know, the finance ministers of the G20, everyone shakes hands. There's a report issued from the OECD, model legislation, model treaty provisions, and then we're all going to go off and implement. How do you get that through the United States Congress and Senate? You know, I'm sure everyone is aware we have very fractious politics these days. And while, you know, we have one party that's in power that holds both houses of Congress, the Senate is equally divided. And under our rules, you have to have 60 votes, you know, kind of a supermajority to break a filibuster and really to pass legislation, unless you use this special procedure called reconciliation. And I'm told that, you know, max in a given year, you can use that procedure twice. So, you know, Biden will really need bipartisan support for anything, you know, that he wants to get through the Senate in the next couple of years. So I think we, you know, need to, you know, be optimistic, but not hold our breath.
No, I think you perfectly portrayed the situation. If I can give perhaps my perspective on this, I think it's a bit cynical, but I think it's more important to strike a deal rather than the precise content of the deal. I think that the objective, I mean, there is a revenue sharing issue, which is really important. And I mean, if I look at the US, it's clear that the US will have in mind the idea of protecting its tax base and the competitiveness of its business. So I think there must be a deal to the extent that it switches off any unilateral action, bearing in mind perhaps that in terms of revenue sharing will not achieve what perhaps market countries, in particular developing countries, would have liked to achieve. And perhaps, but I'm just speculating, perhaps that the way forward would be to close this and to revisit some of the UN member countries' issues at a later stage. But I think for me, in particular in light of the COVID crisis, the main dimension of this is to have a deal being able to switch off unilateral measures, which are completely unpredictable. And I think that the fact that it may not be a perfect deal is obvious. Just like when we had the first part of the BEPS initiative in 2015, we didn't have all the action items being minimum standard. We had best practices to reflect political differences, big countries, small countries, market countries, etc. But I think it's really important to secure the deal and probably revisit some of the allocation issues later on. As a concluding remark, perhaps, and it's more a fundamental issue, and I will perhaps give the floor to Norman. It's of course the policy or the conceptual justification of allocating residual profits to market countries. From an academic standpoint, it's been heavily debated. At the end of the day, and I don't know if we can agree on that. I think that as long as we stay in the range of corporate income tax, at the end of the day, I think it's a political discussion. So I wouldn't search too much for various justification. I think as long as we stay in the range of corporate income tax, how much we allocate to market countries is basically a political discussion. So I think perhaps, Norman, I will give you the floor to comment on what we said and this particular last item.
Yeah, no, I would agree to the last statement, but also highlighting that the project is addressing the digitalization of the economy, and that's something real. So the way how businesses operate, and that they are able to significantly in participate in a market economy on a remote basis, but nevertheless being there significant and sustained engagement in the market economy. I mean, that's a fact, and I think that's what the whole project is trying to address. But I agree that then the amount or the quantum of the reallocation, that's at the end of a political decision.
Okay, I think we are precisely running out of time. I would like to ask if there is any closing comments, anyone wishing to make a closing comment at this stage?
Well, yes, in the 1920s, when the League of Nations, they were making their reports, and somehow they allocated taxing rights between residents and source countries. That itself in the 1920s was based on some legal and economic principles, but it also had a political dimension to it, and it was a political compromise, which was, again, the work was driven heavily by the United States in the 1920s. And again, once again in 2020, now we're in 2021, in this new decade, 100 years after, we will also have a political compromise. And I just wanted to mention that political compromise is also extremely, is relevant. And we as tax professionals, we should not only look at legal principles, economic principles, but when you're dealing with international tax law, there's an international relations dimension to it. There's a political dimension to it, and the principle of political negotiations also needs to be taken into consideration.
Thank you very much, Vikram. Guglielmo?
Well, I think that I agree with you that it's political. That would help in order for countries to implement the mechanism domestically, because it is true what Norman said, that we are, tackling the digitalization of the economy, but overall in some countries still we have principles, either ability to pay or the separate entity approach. And so to introduce rules such as this mechanism would never work without a political commitment at a supranational level. So if I think of members of parliament of one country, a traditional country, a civil law country, for instance, making a proposal like the AmountA mechanism, it will never fly. I think it can fly only because there is an international political commitment. And I think that OECD should look at how to implement all of this, because you cannot implement it with a blueprint report, obviously. You need legislation. So probably you will need a treaty, because by having a treaty, then all the domestic issues would more easily evaporate. If on the contrary, you leave it to domestic rules, it's going to be very difficult, and you would never have consistency. So the next step would be, in my view, to have some sort of drafting just to make people start thinking about actual rules and how they would operate.
Yeah, I think what you're raising, the point that you're raising is perhaps an important one, a turn point that we have also witnessed since the first part of the BEPS initiative, namely the fact that with the emergence of minimum standards, domestic parliaments end up putting into domestic legislation something that they have no choice not to put in. For example, the modified nexus approach for patent boxes is not a matter of debate. It's a minimum standard. The decision has been taken before it is presented to Parliament. And I think this is quite revolutionary. It raises some, of course, controversial questions in terms of democracy and so on. But at the same time, it also perhaps also, as you say, shifts a bit the burden to the OECD since, of course, there is an implementation task which is much higher than before, if, let's say, we want to be serious about multilateralism and coordination. So I think we are pretty much done.